specific transaction cycles. So we're still on internal controls. We'll get a little bit of repetition in a later section with these different transaction areas. So that's good to get a little more repetition. But right now, our focus is on internal controls that relate to these different transaction cycles. And what sometimes makes this a little hard, at least to me anyway, is all this is written as if we're auditing this gigantic company with people hired for every nitpicky little position imaginable. And it's hard for us to visualize that because most, if not all of us, really haven't had any experience with a gigantic company that has a receiving clerk and a treasurer or whatever. So that makes some of this a little hard to get a little bit of a grasp on, to me, and maybe to you guys too. But it's okay. There's a little memorization here. Keep in mind, a lot of this is theoretically speaking, this is what should be done. Realistically speaking, something probably different will be done, but that's kind of the way this is. It's like, here's what should be done in a perfect world type thing. Okay, so we have a little introductory section here to kind of get us going. They tell us what they mean by transaction cycle. So we're talking a grouping of transactions. It's neither here nor there as far as what we need to learn about, because each upcoming chapter deals with a specific transaction cycle. So we'll understand what that means. But they group them this way because control risk can be, constant within those specific categories because they're all kind of subject to the same thing, right? So a transaction cycle is the highest level of aggregation for which control risk may be viewed as constant. So you could see some conceptual ideas there that could show up, I suppose, in a different question, but probably not. Here's where we get into the meat of it. The different internal controls. They give us a little acronym here, which is fairly good. Internal control should scare segregation of duties, controls as in physical access controls. It's a little vague, right? So I had to add that in. Controls as in this, right? Authorization, reviews as in performance reviews, and then the kind of one they kind of had to grasp for a little bit was EDP-IT, information processing. EDP, electronic data processing. So it's not perfect, little acronym, but yeah, good enough. You won't have to memorize these. You'll know them by heart by the time we're done with it anyway. So segregation of duties, we're familiar, hopefully, with all of this. Essentially, the same employee should not do, these three things should be segregated among the different employees. A different employee should do each of these different things, right? Can't seem to get my words out on that, but you need a different person authorizing, different from the person who actually has custody of assets, also different from the person who's actually doing the record keeping. Very heavily tested, as you know, probably by going through the test questions. They'll give you scenarios and you'll have to figure out, okay, which of these is not a good thing. And you're looking for whatever scenario they give you where somebody's doing two of these things, right? So it becomes fairly easy. You just have to oftentimes put their little scenario into normal everyday words and figure out what the heck they're saying. So you don't want somebody authorizing something who also has their hands on the assets, and you don't want those same people who are doing the record keeping. Otherwise, they just kind of have their own way with the whole, the whole arena there. They can have their way with it. They can authorize something. They can hide it in the records with the record keeping. If they have custody assets, they can stick it in their pockets, right? So that's heavily tested. Controls, safeguarding assets, pretty self-explanatory right there, right? Authorization, same. Reviews, actual performance should be compared with budgets and forecasts, et cetera, et cetera. All self-explanatory, but segregation of duties, that's the one that's really heavily tested. And and then into this IT controls. And this gets a little into some of our topics that we talked about in BEC briefly anyway. We have general controls, which, just like they say, they're general, they're widespread, they have a big effect on a bunch of different areas, right? And then more specific application controls. So introductory things here. The questions were, there's only 2 of them. Oh, wrong set. There we go. And they're both good. Number 1 said proper segregation of duties reduces the opportunities to allow persons to be into position to do and what, look for, they're not being very specific really here. They're just being very general. What in general does segregation of duties reduce the opportunity? It reduces the opportunity to carry out some fraud and cover it up, right? That's the whole idea of segregation of duties. We want to reduce those opportunities. Somebody who has their hands on the assets shouldn't be able to conceal it in the records. Somebody who authorizes something shouldn't be able to get their hands on, et cetera, et cetera. Number 2, an auditor suspects that certain client employees are ordering merchandise for themselves on the net without recording the purchase or the receipt of the merchandise. When the invoices arrives, one of the employees approves the invoice for payment. After the invoices are paid, they destroy the invoice, they destroy the vouchers. In gathering evidence regarding the fraud, the auditor would most likely select items for testing from the file of what. All right, this is a good typical question. They'll give you some scenario, very detailed scenario. And you just have to think it through, and you just have to kind of get the information straight in your head and be like, all right, here's what they did. How can I figure this out if they destroyed this, if they screwed around with this? If I'm trying to uncover this, which from this list of 4 multiple choice things will help me do that? So they're not recording the purchase. They're not recording receipt of the items. The person doing the fraud approves the invoices for payments. The invoices are destroyed, so we don't have that. So what does that leave? That leaves the cash disbursements that are actually paying for these things. That's the base they didn't cover, right? You should be able to find, well, okay, here's somebody paying for something. Where's the documentation backing that up? And furthermore, once you found that documentation, where's the authorization and all of that? Okay, you wouldn't be able to find anything to back up those disbursements because it's all been destroyed and it's all looking rough. So that cash is leaving the bank, but there's nothing else kind of recording anything. All right, so that's just introductory. Let's get into the specifics now. All right, so they divide these into the different transaction cycles, which does make it nice and neat. I kind of took a little bit of extra care in organizing my thoughts and my notes on these just to kind of get it, because it gets a little overwhelming. So I like to have it in a better order. So this is all about revenues being earned, receivables being dealt with, and then collecting the receivables. That's the transaction cycle we're dealing with here. Actually, the cash part of it's in the next chapter, but so to me, all of this mess right here is kind of the hard part of these chapters. Just trying to figure out and visualize these processes that are going on. Purchase orders received from a customer. All right, okay, we understand that. Hey, I want to buy this from y'all. Purchase order, they're ordering something. But then it's like, okay, sales order. All right, purchase order, sales order, and it just drives me crazy a little bit. So a sales order is prepared by us, the company. Once they, like, all right, we got an order. Okay, we can do it. Let's get the sales order going. Sent out for credit approval. Here is an important thing that shows up in many questions. Credit approval for customers. So if customers want to buy on credit, the sales staff is not the one to approve that. There's a bit of a conflict there because the sales staff is going to have the incentive to approve credit for everybody because they're making a sale, right? So that's an important point that does show up in test questions quite a bit. We don't want our sales staff approving credit. We need someone else to do that. So once credit is approved, then you've got the sales order sent to 3 different places: shipping, billing, accounting. All right. It's overwhelming a little bit, right? So you've got your shipping documents. Bill of lading is a term that shows up in your questions sometimes. So a bill of lading is just a detailed listing of the shipment. So the shipping documents, and really anything that we're dealing with for the most part, should be pre-numbered. That's just a good control of anything, like our checks and our checkbook, just pre-numbered numbers, right? So the shipping document should be pre-numbered, prepared by a shipping department. Goods are shipped by the shipping department. A receivable is then created, right? So then you got the billing department in this perfect gigantic company that has all these different departments, right? They're going to prepare the sales invoice, and they're going to compare some documents. So these different, there's all these different checks. It's like, all right, sales invoice. Hey, let's prepare this and let's look at the shipping documents. Let's look at the sales order and all these invoices, make sure everything agrees. And then the invoice is sent to the accounts receivable department and to the customer. And then the accounting department's going to do the record keeping, right? So this to me is the hard part, is just kind of like, okay, this is a lot going on with all these departments that's hard to visualize. So when studying for a section like this, to me, it's easier to let the example questions kind of guide you through. You're like, all right, let's get a grasp on this content from the questions they're asking. Other audit considerations kind of down here at the bottom. Returns, should they happen, should be accounted for by an independent clerk from shipping and receiving. That would be good to keep those separate, because the more people that you can have involved, I guess the better is kind of the bottom line on these things. There's the pre-numbered thing again. Make sure you account for missing numbers in the sequence. That would be a problem. And obviously the accounts receivable should be reconciled to a ledger that shows the detail, individual customers and what they owe, right? But you read this section, it's like, I don't know that I've got a really good grasp on what they're trying to tell me. That's where the questions kind of come in handy, right? Sometimes, the way we like to do things is read all this, feel like we understand it, and then ace all the questions. It's not always it doesn't matter, right? These questions are a study material for us as well, right? So as I'm studying for exams like this, I don't get bothered if I miss the exam questions that could follow. I use those to beef up my knowledge. I'll think about them. I won't just sit there and click A on every one of them and let it spit the answer out to me. That's not a good idea. But I'll think about it. I'll question myself and I'll be like, okay, I feel like this, but it could be this. And then I'll look at the answer, and then I'll go back and revisit my notes and key in more notes. And then I feel more comfortable, right? And they gave us a lot of questions here.
They get really wordy too.
They get wordy.
By the time I get done with the last answer choice, I don't even know.
Yeah, they can get wordy. They do require a lot of thought sometimes. So let's look at it. These earlier sections we're going to go a little slower in these, so the later sections might go a little faster. Okay. Which of the following could indicate source document fraud? All right, that's a short question, right? So source document fraud. So the answer ends up being, if we have the same invoice number appearing on different invoices, that's a problem. You know, a sales invoice, we're not going to use a sales invoice multiple times, right? You know, we pre-number these things. That would be a horrible idea to use the same invoice several different times. You can clearly see the problems that could result from that, right? What makes this a little harder though, and requires a little bit of, I don't quite understand this, let me dig around and figure it out, is that A seems like it would be a problem too. Because A says the same customer purchase order number appears on different customer invoices. That sounds like a problem. It's like, you know, we like to pre-number everything. But that's not the case with purchase orders. You know, this is someone ordering stuff from us and doing a little digging. Companies have processes in place to where, you know, repeat customers, long-term customers have these standing purchase orders that enable them to order the same thing multiple times throughout the year. It's just like, all right, let's order. All right, let's order again. So to me, having A on here is what made this one a little harder, but I'm still way uncomfortable with C. So this makes it doable, right?
But at least they will throw out 2 right off the bat.
Yeah, yeah.
That's at least, you got 50-50. That's nice.
Huh?
So you get down to 50-50.
50-50, yeah, that's not bad. And we can reason through the rest, right?
Yeah, exactly. Which seems the most wrong? Right.
Do what?
Let's say which one seems the most wrong?
Which seems the biggest deal, you know. But yeah, the purchase order is received from the customer. Sales invoice is something we are preparing. So that one's doable. All right, number 2. They're getting a little ahead of us on this, but I think we can understand what they mean by it. And, you know, presumably we've had an undergraduate audit class anyway, because we have, it's a prereq for this course. An auditor's test of controls for completeness for the revenue cycle usually include determining whether what. All right, so, you know, completeness is the idea of, and, you know, as I'm reading questions like this, my thought processes, and maybe even something I'm jotting down, gathering my thoughts, I might write down, all right, completeness. And I put that into more logical wording to where I can reason through it a little better. Completeness is, did the things that happened actually get recorded, right? Are our records complete? Right? So that's what we're trying to figure out. So I have that in better words now. Here's what I'm looking for. I'm testing whether the things that actually happened did get recorded. So then I look at each of those 4 and figure out which of these would help me determine whether the things that actually happened did get recorded. So A says each receivable is collected subsequent to year end. So here you're taking something that was recorded and making sure that it did what it should. It wouldn't catch anything that wasn't recorded. So A wouldn't work. B, here we're looking at everything that got shipped. And then we're going to make sure it got invoiced. That would help us, right? So, you know, we're taking something that happened and making sure that we can find it in the records. That's our test for completeness, right? Looking at everything that got shipped. You know, an invoice is prepared for each shipping document. You know, billing prepares invoices and sends it to AR. AR records it. All right, well, let's back off of AR because we're making sure everything is complete that was recorded in AR. So let's back off in the process and figure out, did everything that gets shipped find its way to AR to get recorded, right? So that's kind of your process for for reasoning through these. Think about in real life, put it in your own words, and just kind of think it through. This is not the kind of thing you can memorize because there's so many different scenarios they can throw at you. C wouldn't accomplish anything. Each invoice is supported by a purchase order. Okay, big deal. D, that would not test for completeness. That would test for proper authorization. So it's a good question and pretty doable, right? Number 3, they throw terms at us that we need to kind of be familiar with. And reading this question made me go back to my notes and add, what the heck is a bill of lading? Because that's, again, something we don't throw around everyday conversation, right? So a bill of lading is prepared by the shipping department. And it's a detailed listing of the things they're shipping. All right. So tracing bills of lading to sales invoices provides evidence that what? So we're taking what the shipping department provided to us, saying, here's what we put in the box to ship. So if we take that and compare it to the sales invoice, which of those, what does this provide evidence of? Well, A is the answer. It gives us evidence that the shipments to customers were invoiced, right? We're starting with the bills of lading. We're starting with the shipments. And then we're saying, all right, were those invoiced? Because that's what we're looking at, right? So, it's pretty logical if you can just get past the whole, these are weird words and this is a lot of weird information. But if you can just kind of dig into it a little bit, they're actually pretty easy if you can just kind of put yourself in the real world to think about it, right? And also look at the others and see, okay, why not this one, right? B says it would provide evidence that shipments to customers were recorded as sales. It wouldn't do that, would it? Just because the bill of lading matches the sales invoice doesn't mean that it found its way all the way into record keeping to get recorded yet, right? So we haven't done enough with this audit test to make sure it was recorded as a sale. We need to get into the journal and the ledger to do that, right? Okay. Skip 4, it's easy. It's talking about a batch system. Batch systems have delays. Number 5. 5 says, which of the following would most likely be the result of ineffective internal control procedures in the revenue cycle? A says, final authorization of credit memos by personnel in the sales department could permit an employee defalcation scheme. That's a long-winded way of saying we don't want sales department authorizing credit. So if you can decipher that sentence to understand that's what they mean, this is really easy, right? And then looking at the others, B doesn't even make sense. It says fictitious transactions could be recorded causing an understatement of revenues and an overstatement of receivables. That wouldn't even work, right? You can't, understating receivables would be a debit and understating revenues would be a debit and overstating receivables would also be a debit. Debits and credits wouldn't work. C says irregularities in recording transactions in the subsidiary accounts could result in a delay in goods shipped. Typically they're shipped and then recorded, right? So that one doesn't really make sense. These things are independent of each other. D says omission of shipping documents could go undetected, causing an understatement in inventory. The shipping documents were undetected, nothing got recorded, then inventory would be overstated, right? Things were shipped, but the inventory wasn't recorded leaving, right? So, good question. Pretty easy to get through. Skip 6, that one's easy. Seven says, which of the following procedures would likely assure that all billed sales are correctly posted to AR? So the answer is take your daily sales summaries and compare them to the daily postings of AR. Simple, right? I mean, they're not all hard. Sales happened. We want to make sure they're recorded. So let's look at the sales that were that we say happened and make sure they were recorded. There's no big mystery there, right? So don't make them harder than they are. 8 just kind of, well, yeah, 8 was kind of tough.
I thought it was accounts receivable.
Just because they're in a great final answer. Proper authorization of write-off of uncollectible accounts should be approved in which of the following departments? So this is a segregation of duties question, really. We don't want record keepers to have authorization. We don't want either of those to have custody of assets either, right? All right, so according to our materials, the duty of a treasurer, should the company have one, again, this is what makes this hard. It's like, how many companies do y'all know that has, hey, I'm the treasurer in the company, right? They prepare, sign, and mail the checks. So they do that. They cancel supporting documents and then send the paid vouchers back to accounting to trigger them to do the record keeping. That is the official duty of a treasurer, should there be one, right? So they prepare the check, they sign the check, they immediately mail the check, they cancel the document, say it was paid, and then they trigger the record keeping to make the entry. But yeah, they're calling it treasurer in here, which I'm assuming the audit standards also refer to it as the treasurer. So I would definitely take that term and go with it. So the treasurer does have a larger duty in the AP department, but we're 2 chapters away from that. I think it's more of a process of elimination. Which of these is the best person to do this? So proper authorization of writing off uncollectible accounts should be approved by which of these? All right, so we don't want the AR record keepers to authorize this type of thing. You can see where that would be a problem, right? So we can throw that out. B, we don't want people having the ability to both grant credit and then later write it off. You can see where that would be a huge problem, right? Like, okay, this person's not going to pay. Hey, I'm going to grant it. That's my buddy. And then like I will write it off later. So we don't want that. AP is just kind of a separate thing altogether. So they don't have any business doing it. So that kind of just leaves the treasurer as the best choice left. Again, I'm not real comfortable with this question particularly. But yeah, there it is nonetheless. It's just not, I feel like that's open to debate, maybe. I don't know, you know what I'm saying? And
Yeah, absolutely.
yeah. But anyway.
After you go through all that, like, I don't know how I would debate you, but sure.
You what now?
Like after you go through and point out how all the other ones are wrong, like, well, I would debate you on it. But
yeah, I mean, I feel like we both all be comfortable that A and B could cause problems. C, I don't think that would cause problems.
doesn't make
It's
sense.
just a different department. Do what?
It just doesn't make
It just doesn't make sense. Yeah, it's just kind of a, how about AP? What qualifications do they have to determine whether this is uncollectible and should be written off? They're doing different things. Number 9, which of the following procedures would most likely not be an internal control designed to reduce the risk of errors in the billing process? So billing errors, we want to make sure whatever we shipped was properly billed to the customer ultimately, right? So which of these would not help us determine whether what was shipped was properly billed? So that's my process for answering stuff like this. I'm like, all right, let me just think about this. Here's what we're really looking for. Let's figure it out if any of these things don't help us, right? So A says comparing control totals for the shipping documents with corresponding totals for sales invoice. That would definitely help, right? That would certainly help. Why wouldn't it? Ship things matches with the invoices. That's exactly what we're looking for. So we're good with A. B says using computer program controls on the pricing and mathematical accuracy of sales invoices. That'd be good. You know, mathematical accuracy is probably an important component of billing. We want to make sure we did it right, right? So we're cool with that. 9, C says matching shipping documents with approved sales orders before invoice preparation. So that one may take us a little more thinking, but this could certainly help, right? You know, billing would compare sales orders and shipping documents to make sure those match up. So that would be a control that would help. So that leaves us, I'll get to that chat in 1 second. That would leave us with D would not help. Reconciling control totals for sales invoices with the AR subsidiary ledger. So that's not going to catch billing errors, right? That's simply going to show that, or whether the amounts you have in mind are correctly recorded and posted. So an error could be made and posted, and all this would do is make sure that that wrong number did get posted in the wrong way that we thought it would, right? So D wouldn't work. Okay, so there you have it. You know, back to our notes. We don't have a whole lot of notes that we can put on there. But if you notice, most of the notes we have are essentially all we can do to have tackled those answers as best we can, right? So reading back through them after having looked at those 10 questions, what do we really know? So here's our cycle again. There's a purchase order that comes from the customer. Sales order happens in the company. We want to make sure credit approval is not granted by the sales staff. We did make sure of that. Once credit's approved, then that kicks everything pretty much into motion from there, right? We're going to have shipping documents prepared by the shipping department. There will be a bill of lading documenting all the goods that are being shipped. All those are pre-numbered. Goods are shipped. That creates a receivable. Billing has their hands on the sales invoice. They have their hands on the shipping documents and the sales orders, and they're going to match all those up and make sure everything's fine. And they're going to send out to AR and say, book it. And AR is going to book it, and it'll flow into the ledger. So there you go. All right. So yeah, a little bit hard to prepare for these, but the more questions we can answer, the better feel we'll get for them on how to tackle those, right? All right, same cycle now, just dealing with the cash part of it. So, or you know, it's a different area, but it's still revenue and receipts. It's just the cash part of it. So there we booked receivables. So now we're dealing with the money coming in. How do we deal with that in the safest way to keep fraudulent things from happening, right? So checks are mailed to the company. They're opened by somebody who does no accounting record keeping. Custody of assets, separate from record keeping, right? These receipts should be listed. Our questions will often call this a remittance list. So that's another term to kind of tuck away. And then these lists go to different departments. Cashier gets them, AR gets them, accounting gets them. So the cashier receives the actual money and prepares the bank deposit. AR deals with the individual customer records, adjust those as they should, matching the remittance list to the bank deposit and that kind of thing. And then additionally, the AR control account gets hit with the credit. Other things to consider here: any check that comes in should immediately be stamped with something like for deposit only. We've seen this in real life quite a bit, I'm sure. Bank reconciliation should be done. We know that. Employees with access to cash should be bonded. We used to have to do in governmental audits, one of our audit tests was to ensure that city clerk and other people handling cash were properly bonded. Receipts should be deposited daily. You don't want stuff sitting around. And then use a lockbox where payments from customers are directly received by the bank, avoiding using the company mailroom altogether. So, we're in the era where we can avoid physically handling things a lot of times, right? This is a little easier, right? This is easier to visualize. This all makes sense. Cash coming in the mail, list it out, send that list to somebody else. Somebody's going to put the money in the bank. Other people are going to do the record keeping. Pretty straightforward, right? They give us 9 questions, but I thought all of these were a lot more easy to deal with than the others. But it also gives us a little bit of an idea of maybe this is something more important than I thought it was as I was reading through it. Like on number 1, immediately upon receipt of cash, a responsible employee should do what? List it out, remittance listing. I've got all this cash. I need to list it out. That's documenting what I got. And that's going to be useful for other people as this cash makes its way through the process, getting where it needs to go and getting into the records, right? So that's the first thing. Whoever receives it makes a list and then sends it along. There's that about bonding employees. That's pretty straightforward. Number 3, upon receipt of customers' checks in the mailroom, a responsible employee should prepare a remittance listing. Okay, there's that information again. That's forwarded to a cashier. A copy of the listing should be sent to the AR bookkeeper to update the subsidiary accounts receivable records. So there you go. That was very straightforward, but I like these because, like I said, reading through the stuff, it's like, okay, I feel like I don't have it all yet. And then I start seeing the question. I'm like, okay, now it's all kind of falling into place a little better, right? But yeah, that's the process. 4, kind of obvious, but maybe a little broad. An auditor would be most likely to limit audit tests of sales transactions when control risk is assessed low for the existence or occurrence assertion concerning sales transactions, and the auditor has already gathered evidence supporting which of these. It's a very broad question, but very obviously you're going to have to be B, right? So it doesn't take a whole lot of thought. Again, we're talking sales transactions. We're making sure that sales that they said happened actually did happen. So the cash receipts and accounts receivable would be the evidence they'd want to make sure and gather, right? Yeah, I don't really know what else to say on that one. Broad, but logical. Number 5, this is just another word for, or another way to describe what we've been calling the remittance list. So do keep in mind, sometimes they may not use the term, they may just describe it, right? Sound internal control procedures dictate that immediately upon receiving checks from customers by mail, a responsible employee should prepare a duplicate listing of checks received, which we've been calling a remittance list. So that's the 3rd time that idea has shown up in these questions. So it starts becoming more and more obvious. It's like checks in the mail, list them. That's what we do. That's our control procedure. 6 requires us to know what lapping is. Hopefully we know. Because, yeah, basically you're pocketing money and you're really not recording it. But then when somebody, when you feel like you do need to record it as being received, then you kind of take it out of somebody else's and bump theirs up. And then you're shuffling money around in the accounts all over the place, trying not to get caught doing it. But meanwhile, somebody's payment is in your pocket. You're just screwing around with the records to hide it over and over and over again. So which of the following would deter that? Segregation of duties between receiving cash and posting the AR. That's going to stop that. It's simple. Let's see, skip 7. These others are pretty straightforward. So these were quite a bit easier than the other. It's just easier to visualize and understand cash being handled. All right, back to the harder stuff again. Expenditures and disbursements. All right. So purchase requisition. All right, so we're buying stuff and paying for it here. So a purchase requisition will be sent to a purchasing department by whoever needs whatever they need. Right, that kicks it off. I actually had to do this week. I needed access to a program for myself, bunker and coats. So I had to do a purchase order actually that I had to do, but we had to get a quote for it, and that purchase order was submitted by Jennifer Tittle to the appropriate place, blah, blah, blah. Anyway, whoever needs materials is going to requisition those with the purchase requisition. Purchasing department will get that, and they're going to say, okay, these guys need this. Let me find the best place to get this from. That may require quotes and bids or whatever, but it may just be a simple, all right, I'll get this from Office Max or whatever. Anyway, once they get approval, they'll prepare a purchase order, and then copies are going to be sent to whoever's requesting it. It's going to be sent to the vendor we're buying it from. It's going to be sent to the receiving department to say, hey, this is coming. And it's going to be sent to accounting to record. So this gets kind of complex in their little theoretical giant company that has all these departments, right? So there you go. Purchase requisition triggers a purchase order. All these different departments get a copy of it, right? So the receiving department have a copy of it. So they're good to receive it. And once they do, logically, they'll say, all right, I was expecting that, matches up, like it, good. Check, report, here it goes to accounting, and here goes the goods to whoever requested them. So that takes care of their job, right? And that makes sense, right? They get the goods, give the goods to who needs it, give the okay to the accounting department saying this happened, report it, right? The accounting department gets it, and everybody's comparing the different things that they already have. So they'll get the receiving report and compare it to the purchase order that they have from the purchasing department. They'll say, okay, the thing that was ordered was actually received. I'm happy if you pay this. And then I'll record a payable to show that we owe this money. And I'll record the inventory to show that we have this asset now, or whatever it was that was ordered. When the invoice arrives, accounting will approve the approved. Here's that voucher word again. So a voucher packet, which has all this mess in it: matched invoice, purchase order, receiving report, and requisition. It all comes together saying this all agrees, right? And there it goes to our friendly treasurer, who pays it and cancels the supporting documents and back to accounting to post. So this is their theoretical perfect world. Here's how this should go. Pretty complex, but also pretty logical, right? So having that general idea of here's what should happen should have us okay to answer the questions, right? So we'll look at these other considerations before we look at the questions, but the department who requests the purchase should indicate their acceptance of the goods before payment is made. Let's not pay for sub-quality or damaged goods. So that would be good practice for, hey, I got it, I'm happy with it, y'all are good to go. 2 signatures should be required on checks. Any signature plates should be kept in a secure place. And that always bugs me. The whole idea of a stamped signature just bugs the heck out of me anyway. But anyway. And then,
What about electronic?
Yeah, it kind of bugs me too. Yeah. The only person who has the ability to sign anything for me is Jennifer. And I trust her with anything. But yeah, Jennifer knows what I need to sign better than I do. So she knows everything. Yeah. Yeah, she cracks me up. Like, hey, I did this, and here's your signature on it. I'm like, cool, thank you. Couple of definitional type things I plugged in at the bottom too: an accounts payable system versus a vouchers payable system. Terms you might come across. So an AP system keeps track of the payables by vendor, and a vouchers payable system keeps track of the individual transactions without summarizing the amounts owed to each individual vendor. So it's identified by a voucher number. This is the type of thing I have trouble actually visualizing how it works. My mind doesn't comprehend this very well, but I understand what they're saying enough to deal with it, though. I think these were actually fairly straightforward. So let's look at them anyway, though. In testing controls over cash disbursements, an auditor would most likely determine that the person who signs the check also does what? This is a good one to make sure that you make note of. The person signing the check needs to mail it. The fewer hands that these things are on, the better. Keeps the opportunity down from somebody intercepting it, modifying it, diverting it somewhere else. So yeah, whoever's signing the thing needs to get it where it needs to go without it visiting anyone else's hands. That makes sense, right? Number 2, which of the following situations could most likely lead to an embezzlement scheme? So I would read through all those and see if any of them were obviously a bad idea, and definitely C jumps out as absolutely not. Access to blank checks and signature plates is restricted to the cash disbursements bookkeeper who personally reconciles the monthly bank statement.
That was easy.
Huh?
That was easy.
Yeah, that was the easy one. Yeah, we don't want.
Is that too easy for CPA?
No, it could be a question. They're not all hard. No. And, they kind of try to lead you down the road of, oh, it's restricted to them. It's like they kind of disguise it as, it sounds like that's a good thing, the way the language they use, or in a way. So no, that's not too easy. That's definitely a good question. Let's see.
We're going to put several of those on our test.
Okay, why not? I might copy and paste that exact one in
I
there
think you should.
just for you.
Thank you. I probably won't get it, but thank you for.
That's a very pessimistic outlook.
Yeah.
Yeah, I wouldn't get it.
I have really bad luck.
Oh, man.
Another easy one.
Let's see. These are fairly obvious. 4 says, which of the following would prevent an invoice being paid twice? Whoever signs the check cancels what they call the voucher packet, which has all those documents, cancel it so it doesn't get paid twice. It's pretty obvious, right? That's why we do things like that. There's the whole idea again about mailing the check should be controlled by an employee who signs the check last. Oh, 5. Let's look at 5. Okay, yeah, those are some words that may not jump out at us as we know exactly what this is. So yeah, let's talk about 5. When the shipping department returns non-conforming goods to a vendor, the purchasing department should send to the accounting department the what? All right, so let's try to figure this out. So goods came that we didn't want. So they got returned by the shipping department. So the purchasing department, who, initiated all this to begin with, they look for the people to buy it from and prepared the purchase order and all of this. All right, what should they do as far as getting word to the accounting department? All right, so A says they should send the unpaid voucher to the accounting department. I think we're obviously okay with saying do not do that because somebody might pay it, right? So they wouldn't have anything on that voucher to show that goods were returned. So, they might say, oh, somebody needs to pay this. Let's get it done. So definitely not that. Same with C, the vendor invoice wouldn't have anything about return goods. The vendor invoice just says, here's what we owe. So no on either of those. So that leaves us with a debit memo or a credit memo. So a credit memo, and this is kind of fuzzy wording in a kind of an unfair way. The credit memo would be something we would issue to credit a customer's account. Debit memo would be something the accounting department would need to know to make the change. So I don't particularly feel like this question is that important. Credit memo is crediting their account, saying that, hey, customer, you don't owe us this. A debit memo would be something to give to the accounting department to say, hey, we don't owe this. Yeah, but still, I don't feel like this is particularly an important question, honestly. But, who knows what they'll throw at you. But yeah, that's the idea. Seven's a good one. An auditor wishes to perform test of controls on a client's cash disbursements procedure, so test of controls. If the control procedures leave no audit trail of documentary evidence, what will we do? Obviously, we have to observe and inquire. That's kind of what we're left with, right? None of the other things would work in this situation. There's no documentary evidence to confirm. C has the confirm as well. And there's no analytical procedures for test of controls. That's a substantive test. So it's a good question, though. All right. And look, they really like this whole who needs to mail the check question, don't they? All right. Oh, 8. In a properly designed internal control structure, the same employee would most likely match vendors' invoices with receiving reports, and also recompute the calculations on the vendors' invoices. That's kind of one and the same, right? All right. Okay, payroll cycle, that goes quick. Very logical, very easy to deal with, in my opinion. Way easier than these other couple of things that we've looked at. So we're talking, the cycle, that's kind of what I was noting at the top. Time cards or salary information leads to paychecks being cut, leads to journal entries being made and flow into the ledger. We know that idea. Our objectives for internal control over payroll is to make sure things are properly authorized. Valid employees are being paid. A lot of frauds that have been carried out have involved fictitious employees. So we want to make sure that these are actually valid employees. Correctly computed, properly recorded, withholdings dealt with properly, access limited, obvious things. Audit considerations, in addition to the very obvious things too. Maintaining employee files is important. Timekeeping is an important thing. Distributing checks, reconciliations, overtime should be approved. Good control is to have a separate checking account specifically for payroll. They only had a couple of questions on this one. Can't remember what they were. Oh, they were both about authorization, I think. Both kind of the same question, which would ensure payment is made only for work performed. Require employees to have their supervisors approve their time cards. That would be the best way to do that. Better than the others, right? This is an actual additional person to corroborate what the employee is saying, right? A says require all employees to record arrival and departure by using a time clock. How easy is that to manipulate? Hey, I'm going to be 30 minutes late. Will you clock me in? Mm-hmm. Right. So that's not going to work, right? B says have a payroll clerk recalculate all time cards. Again, that goes back to the idea of
they won't know the work was actually done.
Right, yeah. Couldn't get the words out, but yeah, they're recalculating what was actually on there. Who knows if what was actually on there is right? That payroll clerk's not in the position to say, I don't think you were there that day at 8 a.m. Weren't you a little late? That kind of thing. And signing their time cards. Yeah, I'll sign it. Why not? And then 2 is essentially the same thing. Miscellaneous cycles. I read it and I'm like, I don't really know what kind of notes to take on this. It's just, they'll throw a question at you and you just kind of have to use your knowledge to deal with it, right? We have a lot of foundational knowledge about things. Put it to work, right? I just didn't see anything for myself to note on any of this. But they gave us questions to look at. When there are numerous property and equipment transactions during the year, an auditor who plans to assess control risk at a low level usually performs. So test the controls for sure, right? I mean, if we're wanting to assess control risk at low level, then we're going to perform tests of controls, but they throw that into a couple of the questions, right? And this really goes back to what we talked about a couple of weeks ago with the whole idea of how the different assessments of risk leads to more or less additional substantive tests. So they could have easily plugged this into that earlier section as a question, but C's the answer. We're going to test the controls, which will allow us to say, okay, control risk is low because we tested it. And why would we do that? That gives us a little bit of a payoff to say, okay, we're happy with tested controls. That makes us able to do fewer tests on the transactions themselves. So C. So yeah, so this goes back to that chapter on the different risks.
That's where I made a mistake. On.
Okay, yeah, it's important to definitely get that straight. So there's control risk and there's inherent risk.
Right. Yeah.
All right, those are what they are. We will assess it either high or low, right?
Right.
So control risk is what we're talking about here. So if we assess control risk, let's say we assess it at the maximum, saying we don't trust control risk at all, then we're going to say, if I don't trust controls at all, there's no point in me testing controls at all. So that will lead me down the road of I better do a bunch of actual tests of details and things like that to give me some evidence, right? Now, the other possibility is, all right, control risk is low. That means I tested some controls and said, these controls are working. So I'm happy. I don't feel like there's a whole lot of risk there. That allows me to say, okay, I'm cool to do a little bit of testing on the details and transactions and things like that, but I don't have to go crazy because I've already done control tests, which is going to kind of like a net, keeping errors from happening, and I'm happy doing fewer tests. So those two categories of tests together work as a team, kind of to say I'm good. Yeah. So yeah, if we're doing tests of controls and we're happy with them, that can lead us to do fewer tests on the transactions and the details of balances and things. Let's see. Which of the following internal control procedures would most likely prevent direct labor hours from being charged to manufacturing overhead? See, I mean, they're being very specific, but we can just kind of use our brains and say, okay, this would keep that from happening, right? So we don't want direct labor to be charged to overhead. So using time tickets to record actual labor worked on production orders, it's a simple thing, but that would be a control, having those time tickets, the documents, all that would help us put direct labor in the right place instead of categorizing it as indirect labor that goes to overhead, right? Three, in obtaining an understanding of internal control concerning inventory balances, which of these would we most likely do? So we want an understanding of internal control over inventory. This is a test of a control, or this is an understanding rather. Reviewing descriptions of policies and procedures. All these others are analytical procedures or substantive tests. So you kind of see what I mean. Yes, this chapter is about, what was it about? Just different things. But it's mostly questions using those specific things to test a more broad idea that could apply to any area, right? Equipment acquisitions that are misclassified as maintenance expense would most likely be detected by an internal control procedure that provides for investigation of variances within a formal budgeting system. Is what it ends up being. So let's see what our choices were. So let's put this question into our own words first. So we're trying to catch things that were recorded as an expense when they should have been an asset. A says segregation of duties in AP has nothing to do with anything, right? B says independent verification of invoices for disbursements recorded as equipment acquisitions. So if you think about that, that wouldn't make any sense either, right? We're looking for things that were recorded as maintenance incorrectly. So if we're looking at invoices that were recorded as equipment acquisitions, that would catch the things that were only correctly recorded as equipment acquisitions, right? We're not going to find anything mistakenly recorded as maintenance expense by looking at only the equipment acquisitions, right? So that wouldn't work. D says authorization by the board of directors for significant equipment acquisitions. It's not really a bad choice either, but it's not really an.
I think I choose D.
Pardon?
I think I did choose D.
You chose D. I mean, it's not a horrible, but it's really not an efficient way to do it. You know, that's hard to do, you know. Yeah.
Nothing related to maintenance. Well,
It'll be hard to start with, you know, finding all the different things that the board authorized and then tracking it through, right? It's not a very efficient test. But it would work. It'd just be a weird and difficult way to do it. And it might work. But C would be much better. You know, it's a broad way of doing it, but these are really big purchases of assets that should be capitalized. And maintenance expense would just be blown out if we incorrectly recorded something there that we shouldn't have. If it didn't get blown out, then it's immaterial and doesn't matter, right? So it's a simple way to do it. I mean, that's a pretty standard audit procedure, is glance at maintenance expense and look for acquisitions that should have been capitalized. But yeah, that's kind of a hard question to navigate, honestly, but it does make sense once we talk about it. 5, which of the following questions would an auditor most likely include on an internal control questionnaire for notes payable? All right, so again, it's like, how do you study for something like this? You really don't. You just think about, if you're an auditor, which of these do we want to know? So do we want to know whether assets that collateralize notes payable are critically needed for the entity's continued existence? Not really, not our problem. Do we want to make sure that 2 or more authorized signatures are required on checks that repay the notes payable? No, I mean, not for this purpose at all. No, it's not relevant to this. It's relevant to other things, but not to this. Do we want to make sure the proceeds from the notes payable are used for buying non-current assets? No, they can do what they want with it. Do we want to know whether direct borrowings on notes payable are authorized by the board? Of course, right? We need to make sure things are properly authorized.
I think what confused me is like that it had to be approved like by the board of directors.
That's specific, isn't it?
Yeah.
Yeah.
Like
Maybe a better way would be properly authorized.
Right.
Yeah, I see what you're saying. Because maybe they don't have a board of directors, right?
Right.
So, yeah, but yeah, don't let something that specific throw you. You know, that D assumes they do have a board of directors,
Right.
so you wouldn't be able to argue D away by saying maybe they don't have a board of directors, you know. But yeah, a better way would have been properly authorized by the appropriate person. 6, when an entity uses a trust company as a custodian of its marketable securities, you start reading that, you're like, oh my goodness, what is this crap, right? All right, when an entity uses a trust company as a custodian of its marketable securities, the possibility of concealing fraud would most likely be reduced if what? So don't worry about the detail here, just see which of these makes sense, right? Think segregation of duties, think collusion, think, the typical things that cause controls not be effective, override of controls and things like that. So A says the trust company has no direct contact with the entity employees responsible for maintaining investment records. In other words, custody of assets, trust company, record keeping right here, collusion, they have the ability to do something, right? So A sounds pretty good. The rest of them are obviously kind of, B, doesn't matter whose name, whose ever name's on there can misuse it, so it doesn't matter whose name's on it. Interest and dividend checks are directly mailed to an entity employee who's authorized to sell securities. That's a bad thing to do. Trust company places the securities in a bank safe deposit vault under their exclusive control. Wouldn't really help one way or the other, I don't think, right? Wouldn't. Reduce the possibility of concealing fraud. So, yeah. So fraud, think of risks of fraud, think segregation of duties, overriding controls, collusion, think of ways to reduce those types of things. Seven, the objectives of the internal control for a production cycle are to provide assurance that transactions are properly executed and recorded, and that what? So that's kind of leading you down a road of duties need to be segregated. So let's see if any of these click. So B ends up being the answer. Custody of work in process and of finished goods is properly maintained. So that keeps record keeping and custody separate. So you could change production cycle to any cycle and tweak wording, and it would be true for anything.
I feel like whenever the answer has like properly maintained,
right.
That's one of the best options.
Yeah, that's a good point. Yeah, anything should be properly maintained, I guess.
Right.
Properly authorized, properly
Yeah.
maintained,
Mhm.
properly. Yeah.
It's a good point. Let's see. Yeah, good enough. All right. That gets us through internal control.
Victory.
What do you think?
Hard.
Hardest part so far. Hard to study for. Hard to visualize some of it.